Good evening everyone, we are the Group 2 and we are here to present and discuss the substantive test of the revenue cycle accounts. But before that, let me first discuss the other part of the revenue cycle activities and technologies. Now we have the real-time sales order entry and cash receipts. Figure 9.5 illustrates a re-engineered sales order system. Interactive computer terminals now replace many of the manual procedures and physical documents. This system provides real-time input and output with batch updating of only some of the master files. For our order entry procedures, we will begin on the sales procedures. Under the real-time processing, sales clerk receiving orders from the customer process each transaction separately as it is received. Using a computer terminal connected to an editor inquiry program, the clerk performs the following tasks in real-time mode. First, the clerk performs a credit check online by accessing the customer credit file. This file contains information such as the customer's credit limit, current balance, date of last payment, and current credit status. Based on the program criteria, the customer's request for credit is approved or denied. Now next, if the credit is approved, the clerk then accesses the inventory master file and checks the availability of the inventory. The system reduces inventory by the quantities of items sold to present an accurate and current picture of the inventory on hand and available for sale. Lastly, the system automatically transmits an electronic stock release record to the warehouse and a shipping notice to the shipping department, and records the sale in the open sales order file. This is a temporary holding file for sales order until they are shipped and can then be billed. Now, we move on the warehouse procedures. The warehouse clerk's terminal immediately produces a hard copy printout of the electronically transmitted stock release document. The clerk then picks the goods and sends them along with a copy of the stock release document to the shipping department. The last department is the shipping and the billing department. The shipping clerk reconciles the goods, the stock release document, and the hard copy packing slip produced on the terminal. The clerk then selects a courier and prepares the goods for shipment. From a terminal, the clerk transmits a shipping notice containing invoice, date, and carrier information to create a shipping log record of the event. The transaction record is removed from the open sales order file and added to the sales invoice file. Finally, drawing from the data in the customer file, the system automatically prepares the customer's bill. After the real-time sales order entry, we now proceed to the cash receipts procedures. In open invoice systems such as this, each invoice is billed and paid individually. Cash from customers may be received and processed as just described or may be sent directly to a bank lockbox. In either case, the remittance advices and the credit memos are sent to the AR department where the clerk enters them into a system via a terminal. Each remittance record is assigned a unique remittance number and is added to the remittance file. Placing the remittance number and the current date in the respective fields then closes the corresponding open invoice record.
The topic that I will discuss is feature of real-time processing. This system is a departure from traditional accounting. A central feature of this system is the use of an events database. Traditional accounting records may not exist per se. For instance, in the example, the sales invoice replaces the sales journal and the accounts receivable subsidiary ledger. Total sales is the sum of all invoices for the period. Summing the open sales invoice, those not closed by the cash receipt and credit memos, provides accounts receivable information. In speculation, such a system does not even need a general ledger because sales return, accounts receivable control, and cost of goods sold can all be derived from invoices in the events database. However, most of the organization prefer to maintain a separate general ledger file for efficiency and cross-checking of processing accuracy. Four advantages make this approach an attractive option for any organization. Number 1. Real-time processing greatly shorten the cash cycle of the firm. Lags inherent in traditional system can cause delay of several days between taking an order and billing the customer. Real-time processing with remote terminals reduces or eliminates these lags. An order received in the morning may be shipped by early afternoon, thus permitting same-day billing of the customer. Number 2, real-time processing can give a firm's competitive advantage in the marketplace. By maintaining current inventory information, sales staff can determine immediately whether the inventories are available. In contrast, batch systems do not provide salesperson with current information. As a result, a portion of the ordered must sometimes be back-ordered, causing customer dissatisfaction. Back-ordered meaning customer order cannot be shipped due to lack of inventory availability. Current information provided through real-time processing enhances firm's ability to maximize customer service, which translates to increased sales. Number 3. Manual procedure tend to produce critical errors such as incorrect account numbers, invalid inventory numbers, and price quantity extension miscalculation. These errors may go undetected in batch system until the source document reaches the data processing, by which time the damage already be done. For example, the firm may find it has shipped goods to a wrong address, shipped wrong goods, or promised goods to a customer at a wrong price. Real-time editing permits the identification of many kinds of error when they occur and greatly improves the efficiency and effectiveness of operation. Number 4. Real-time processing reduces the amount of paper document in a system. Hard copy documents are expensive to produce and clutter the system. The permanent storage of these documents can become a financial and operational burden. Documents in electronic format are efficient, effective, and adequate for most audit purposes.
Let's move on to the point of sale system. What we have previously examined are the businesses which are able to extend credit to their customers. However, not all businesses can function this way, like the grocery stores which only exchange goods for cash. These transactions are consummated at a point of sale. What do we really mean by a point of sale system? A point of sale system allows a business to accept payments from customers while keeping track of the sales. However, only cash, checks, and bank credit card payments are valid. These systems are used extensively in grocery stores, department stores, and other types of retail organizations, as shown in Figure 9.6. The POS process occurs like this. As a customer buys a product and goes to the cashier to pay, the POS system will calculate the price for the item and records the sale. Then as the customer pays, a receipt will be printed as the POS transaction was finalized. To dig deeper on how the POS system occurs, let us discuss the flowchart shown in the screen. First, the checkout clerk scans the Universal Product Code or the UPC label on the items being purchased with a laser light scanner. The system is accordingly connected online to the inventory file, from which it retrieves product price data and displays this on the clerk's terminal. As items fall to minimum levels, they are automatically reordered. When all the UPCs are scanned, the system automatically calculates taxes, discounts, and the total for the transaction. In case of credit card transactions, the sales clerk obtains transaction approval from the credit card issuer via online connection. When approved, the clerk prepares a credit card voucher which the customer signs. One copy of the voucher is given to the customer, while the second copy was secured in the cash drawer of the register. On the other hand, for cash sales, the payment is secured in the cash drawer. As clerk enters the transaction into the system, a record of sale is added to the sales journal in real time. The record contains the date, time, terminal number, total amount, cash or credit card sale, cost of items, sales tax, and discounts taken. One copy is given to the customer as a receipt, and the other is secured internally within the register which the clerk cannot access. The supervisor unlocks the register and retrieves the internal tape when the shift is over. Then the cash drawer is replaced with a new one containing a known amount of startup cash for the next clerk. Then the cash drawer is accordingly taken to the treasury by the supervisor and the previous clerk to reconcile the amount against the internal tape. Organizational policy specifies how cash discrepancies are handled, wherein some organizations require clerks to pay via payroll deductions, while other organizations establish a materiality threshold. However, excess shortages are reviewed for possible disciplinary action. Upon reconciliation, the clerk prepares a cash reconciliation form and secures one copy as a receipt for cash remitted and records cash receipts and cash short or over in the cash receipts journal. Furthermore, the clerk files the credit card vouchers and secures the cash in the safe for deposit in the bank at the end of the day. At the end of the day, the cash receipts clerk prepares a 3-part deposit slip for the total amount of cash received. One copy is filed and the other 2 accompany the cash to the bank. As cash is involved, armed guards are often used to escort funds on the bank repository. Finally, a batch program summarizes the sales and cash receipts journal, prepares a journal voucher, and posts the general ledger as shown. Note that this accounting entry shown may vary among businesses. Some companies may treat credit card sales as cash, while others may maintain an accounts receivable until the credit card issuer transfers the funds into their account.
Substantive test of revenue cycle accounts. This section deals with the substantive tests that an auditor may perform to achieve audit objectives related to the revenue cycle. The strategy used in determining the nature, timing, and extent of substantive tests derives from the auditor's assessment of inherent risk, unmitigated control risk, materiality consideration, and the need to conduct the audit in an efficient manner. Revenue cycle risk and audit concern. In general, the auditor's concern in the revenue cycle pertain to the potential of overstatement of revenues and accounts receivable rather than their understatement. Overstatement of accounts can result from material errors in the processing of normal transactions that occur throughout the year. In addition, the auditor should focus attention on large and unusual transactions at or near period end. Here are the examples of specific issues that give rise to these concerns. Recognizing revenues from sales transactions that did not occur. Recognizing sales revenues before they are realized. Failing to recognize period-end cut-off points, thus allowing reported sales revenue for the current period to be inflated by post-period transactions. Underestimating the allowance for doubtful accounts, thus overstating the realizable value of accounts receivable. Shipping unsolicited products to customer in one period that are returned in a subsequent period. Billing sales to the customer that are held by the seller. In resolving these concerns, the auditor will seek evidence by performing a combination of tests of internal controls and substantive tests. Tests of controls include testing both general controls and application controls specifically related to the revenue cycle procedures. Understanding the data. The following tests involve accessing and extracting data from accounting files for analysis. To do this, the auditor needs to understand the systems and control that produce the data, as well as the physical characteristic of the files that contain them. Before we proceed, however, we need to review a few salient points regarding file preparation. First, the auditor must verify that he or she is working with the correct version of the file to be analyzed. To do so, the auditor must understand the file backup procedures and, whenever possible, work with the original files. Second, ACL can read most sequential files and relational database tables directly, but esoteric or complex file structure may require flattening before they can be analyzed. This process may involve additional procedures and special programs to produce a copy of the original file in a format that ACL can accept. If the client organization system personnel perform the flattening process, the auditor must verify that the correct version of the original file was used and that all relevant records from the original file were transferred to the copy for analysis. The audit procedures described are based on the file structure in Figure 9.9. These structures indicate the primary keys, the relevant data fields, and foreign keys that permit logical linkage between files. Customer file. The customer master file contains address and credit information about customers. The credit limit value is used to validate sales transactions. If the sum of the customer's outstanding account balance and the amount of current sales transaction exceeds the pre-established credit limit, then the transaction is rejected. Sales invoice file and cash receipts file. Sales invoice file along with the line item file captures sales transaction data for the period. The sales invoice file contains summary data for each invoice. When an order is shipped to a customer, a record is added to the file. Summing invoice amount for all records in the file yields total sales for the period. When customer cash payments are received, they are matched to the open invoice record, which is then closed by placing the current date in the closed date field. At that time, a record is added to the cash receipts file. The remittance number, which is the primary key of the cash receipt record, is added to the invoice record as a foreign key. The accounts receivable balance for a particular customer is calculated by summing the invoice amount fields for all the customers' open invoices. Total accounts receivable for financial reporting purposes are the sum of all the open invoice records in the file. Line item file. The line item file contains a record of every product sold. Since a single transaction can involve one or more products, each record in the sales invoice file is associated with one or more products in this file. Notice that the file contains a primary key comprised of two fields, invoice number and item number. Both fields are needed to uniquely define each record in the file. They also provide links to related records in the sales invoice and inventory files. Although financial reporting of sales and accounts receivable information requires only the data contained in the sales invoice file, the line item file is needed for operational tasks such as billing, customer service, marketing, and auditing. For example, sales details in the file allow marketing to evaluate the demand for its products. These data also provide audit evidence needed to corroborate the accuracy of price times quantity calculation that are summarized in the sales invoices. Inventory file. The inventory file contains quantity, price, supplier, and warehouse location data for each item of inventory. When products are sold, the quantity on hand field in the associated records is reduced by the value of the quantity field in the line item record. The quantity on hand field is increased by inventory receipts from suppliers. Shipping log file. The shipping log is a record of all sales orders shipped to the customers. The primary key of the file is the bill of lading number. The data in this field are useful for verifying that all sales reflected in the sales invoice file were shipped in the period under review. As an efficiency tool, this data can also be used to determine if customers' orders are being shipped in a timely manner. File preparation procedures. The data contained in the files shown in the Figure 9.9 provide evidence that may either corroborate or refute audit objectives. Most of the tests described in the following section involve using ACL to access and extract data from these files. For a detailed explanation of ACL commands, review the instruction manual that accompanies the ACL software and consult ACL online help feature. As a primary step in using ACL, each file needs to be defined in terms of its physical location and its structure. Through a series of easy-to-use pop-up menus, ACL Data Definition Wizard allows the auditor to specify the name of the file, specify its location, and define the file structure in terms of the length of each field and the data type contained in each field. When the file definition is completed, it is saved under a unique name assigned by the auditor. All the future file access is accomplished by simply selecting the file definition from an ACL menu. ACL automatically locates the file and presents it on the screen, where the auditor can review and manipulate its contents. Sometimes, the actual content of a data field are different from what they are supposed to be. For example, a numeric field in one or more records may contain alphabetic data because of a program error or a clerical mistake. Also, a field may contain corrupted data because of an error in the file flattening process. Whatever the cause, prior to performing any substantive test on a new file, it is important to validate its contents. Invalid data will distort the test result and may cause a system failure. ACL verify command analyzes the data field in the selected file to ensure that their content are consistent with the field type in the file definition. Any validity errors detected by ACL need to be traced to their source and resolved. The auditor may also find batch control totals to be an effective means of verifying data integrity.
Testing the accuracy and completeness assertions. Auditors often precede substantive tests of details with an analytical review of account balances. An analytical review is used by auditors to assess the reasonableness of account balances. This is done by comparing changes in account balances over time as well as by comparing related accounts. In the case of the revenue cycle, an analytical review will provide the auditor with an overall perspective of trends in sales, cash receipts, sales returns, and accounts receivable. Analytical procedures do not necessarily require computer technology. For example, the auditor may compare reported sales for the quarter with those for the same period in the previous years. Ratio analysis may be used to compare total sales to cost of goods sold, sales to accounts receivable, and allowance for doubtful accounts to accounts receivable. Significant variations in account balances over time or unusual ratios may signify financial statement misrepresentations. However, analytical procedures can provide assurance that transactions and accounts are reasonably stated and complete, and may thus permit the auditor to reduce substantive tests of details on these accounts. Review sales invoices for unusual trends and exceptions. A useful audit procedure for identifying potential auditees involves scanning the data files for unusual transactions and account balances. For example, scanning accounts receivable for excessively large balances may indicate that the organization's credit policy is being improperly applied. Another one is credit balances in accounts receivable may suggest unusual sales return activity or errors in the application of cash receipts to customer accounts. The auditor can use ACL's Stratify feature to identify such anomalies. The Stratify function groups data into predetermined intervals and counts the number of records that fall into each interval. Using data similar to the sample data illustrated, the Stratify function will produce the report for the sales invoice file. Figure 9.10 illustrates the stratification of sales invoice file. The report groups the invoice amount field into 10 intervals based upon the upper and lower limits of the data in the field. Analysis of the results allows the auditor to identify unusual trends and exceptions. For example, the minimum invoice amount was negative $3,582.98 and the maximum was $5,549.19. Next, 56% of the sales are between $310 and $1,620. Another one, only 2 items were sales over $4,894. And also, 49 items constitute $49,283 of negative sales. The auditor can use other ACL features to seek answers to questions raised by the preceding analysis. For example, since this is a sales invoice file, it should normally contain only positive numbers. Negative numbers may have been inserted into records in a number of ways. Like number 1, they could be the result of a defective computer program. 2, an intentional clerical error. 3, an effort to reverse the effects of erroneous sales transactions. Or number 4, a fraudulent attempt to reduce a customer's accounts receivable balance. Although the auditor cannot specifically identify from the stratification which records are causing the anomalies, the potential problem has been flagged. The auditor will probably want to pursue this matter further, but to do so will require more detailed information. ACL also provides a filter capability that can be used to select or ignore specific records from an entire file. Using this feature, the auditor can select from the sales invoice file only those records with negative invoice amounts. The resulting view of the file is much smaller and provides the auditor with the details needed to investigate these anomalies. With knowledge of specific customer account numbers, invoice numbers, and sales dates, the questionable items can be traced to their sources for resolution. Review sales invoice and shipping log files for missing and duplicate items. Searching for missing and/or duplicate transactions is another important test that helps the auditor corroborate or refute the completeness and accuracy assertions. Duplicate and missing transactions in the revenue cycle may be evidence of over or understated sales and accounts receivable. Duplicate sales invoice records may indicate a computer program error that materially overstated sales and accounts receivable. On the other hand, a missing sales invoice may point to an unrecorded sale that was shipped but not billed, thus understating these accounts. Or also, it may indicate nothing more than an invoice that was issued and voided because of a clerical error. ACL is also capable of testing a designated field for out-of-sequence records, gaps in sequence numbers, and duplicate values for the entire file. Using this feature, the auditor can scan the invoice number field of all records in the sales invoice file. The ACL system will return an on-screen report similar to the table presented. The partial report shows that 243 records in the sales invoice file are either duplicated or missing. In resolving this issue, the auditor will need to interview management and employees involved in the process and seek answers to the following types of questions presented on the screen. Tests for missing and duplicate documents can also be performed on the shipping log file. Consider the sample data in the table presented. In this example, the auditor will test the invoice number field for gaps and duplicate records. A duplicate record may indicate that the same product was shipped to the customer twice. If we presume that the customer was billed only once, then the organization has forfeited the revenue from the second shipment. Missing invoices may denote that some customer orders are not shipped at all. Depending on the circumstances, sales and accounts receivable may be overstated. Here is an example of how a single test procedure can support more than one audit objective. Invoices missing from the shipping log provide evidence that also tests the existence or occurrence assertion. The auditor should review the shipping log for the following period to determine if the missing invoice numbers are recorded there. If so, this will indicate that the merchandise was shipped after the cut-off period. It may be necessary to adjust the sales and accounts receivable balances accordingly.
Next up is a review line item and inventory files for sales price accuracy. The audit aim of accuracy is supported by evidence from testing product prices charged to customers, but sometimes, sales personnel are given only limited authority to negotiate prices with the customers. Significant price differences between the suggested retail price and the price actually charged may indicate incompetence, clerical problems, or salespeople acting outside of their authority. For example, a retail outlet such as department store will usually establish a non-negotiable pricing policy. Sales prices are calculated automatically by the point of sale system to avoid given errors. However, a pricing inconsistency in such a setting may indicate a computer program error or the use of obsolete pricing data. Traditionally, auditors would check pricing accuracy by comparing invoice sales prices to published price list. However, because of the physical effort required, this method can only be used on a trial basis. So the auditor will use ACL to compare the prices charged on each invoice in the file for the time period under consideration. Let us look at this figure. First, let us notice that the actual sales price charge is stored in the sales price field in the line item file. The suggested retail price for each product is the retail price field in the inventory file. In addition to that, the two files have item number as a common field. This field is the key field on which the two files are related. Using this, the objective of the test is to match each record in the line item file with the corresponding record in the inventory file. Significant discrepancies can then be identified and investigated through this process. First, both files need to be ordered according to their common key, which is the item number. Since it contains the details of the invoice file, it is probably organized by invoice number at this time. It is therefore necessary to sort this file on the item number field to place it in the same order as the inventory file. This process involves simply opening the file and using the ACL's sort feature. The next step is to combine the two files to create a third. ACL accomplishes this with its join feature. The auditor has several options when joining files. The one most relevant to this test is to create a third file that consists only of match records. In other words, the new file will contain only the line item and inventory records whose value for the item number field match. Usually, it is neither necessary nor desirable to include all fields from both of the original files. In this example, the fields needed from the line item file to verify pricing accuracy are invoice number, item number, and sales price. On the other hand, from the inventory file, the fields are description and retail price. At this point, the resulting file may still be very large. Scanning the file visually for price differences could be time-consuming and ineffective. Here again is an application for a filter. Through this, the auditor can easily create a filter that will ignore all records in which sales price and retail price are equal, and the resulting file will contain only price discrepancies. Next up is testing for unmatched records. A variation on the preceding test can be used to address some related issues. By selecting a different join option, the auditor can produce a new file of only unmatched records. There are two possible causes for unmatched records. The first is because the value of the item number field in the line item record is incorrect and does not match an inventory record. Since the operational assumption is that the inventory master file is correct, then any line item records in the unmatched files are errors. The presence or absence of such errors is evidence that either contradicts or supports the accuracy claim. The second and last source of unmatched records is the inventory file. The presence of inventory records in the unmatched file means that there were no corresponding records in the line item file. Remember, this result is not an error. It means that these products did not sell during the period. After adjusting for any seasonal influences on sales, such evidence may refute the valuation assertion. The auditor may require that the inventory be written down to reflect its market value.
Alright, so the next topic to be discussed is testing the existence assertion. One of the most widely performed tests of existence is the confirmation of accounts receivable. This test involves direct written contact between the auditors and the client's customers to confirm account balances and transactions. The confirmation process states that auditors should request confirmations of accounts receivable except in the following three situations. First, accounts receivable are immaterial. Second, based on a review of internal controls, the auditor has assessed control risk to be low. And third, the confirmation process will be ineffective. This last point is worthy of further explanation. Because of the way some organizations account for their liabilities, they may be unable to respond to requests for confirmations. For example, government agencies and large industrial organizations often use an open invoice system for their liabilities. Under this approach, invoices are recorded individually rather than being summarized or grouped by the creditor. In this environment, no accounts payable subsidiary ledger exists. Each invoice is paid or closed as it comes due. For financial reporting purposes, total accounts payable is calculated simply by summing the open or unpaid invoices. Determining the liability due to a particular creditor, which may consist of multiple open invoices, is not such a simple task. The auditor should not assume that an organization using this approach would invest the time needed to respond to the confirmation request. Under such circumstances, the confirmation process would be ineffective. In the discussion that follows, we assume that accounts receivable are material and that the auditor has decided to request confirmations from the client's customers. The confirmation process involves 3 stages. First, selecting the accounts to confirm. Second, preparing confirmation request. And third, evaluating the responses. For the first stage, we have selecting accounts to confirm. Given the file structures used in our example, selecting accounts receivable for confirmation involves processing data that are contained in both the customer and the sales invoice files. Each customer record is associated with one or more sales invoice records. Recall from a previous discussion that the accounts receivable balance for a particular customer is calculated by summing the open sales invoices. Or in our example, these are those with no values in the close date and the remittance number fields. Once a cash is received in payment of an invoice, it is closed by placing the payment date and the cash receipt number in the respective fields. Thus, the sales invoice file provides the financial information needed for the confirmation request, and the customer mailing information is contained in the customer file. Obtaining of a set of accounts for confirmation requires 3 steps. First step is to consolidate the invoices by customer. Second is to join the data from the 2 files. And third, select a sample of accounts from the joined file. The first step in the process is to consolidate all the open invoices for each customer. Using the sample data presented in this table, ACL's classify command allows the auditor to set a filter to select only the open sales invoices and to summarize the invoice amount field for each record based on the customer number. The summarized records are then passed to a new file called classified invoices. The next step in the confirmation process is to join the classified invoices file and the customer file. It is to produce another new file called accounts receivable, which is presented on this table. As noted previously, the join feature allows the auditor to select only relevant fields from each of the input files when creating the new file. In this example, credit limit, which is not needed for preparing the confirmations, has been derived from the new accounts receivable file structure. In a moderate to large size organization, the accounts receivable file may contain thousands of records. Rather than confirming all of these accounts, the auditor will probably choose to select a sample of records. And to assist the auditor in this task, ACL's sample feature offers 2 basic sampling methods. First is the random or record sampling, and the second is the monetary unit sampling. The choice of the methods will depend on the auditor's strategy and the composition of the accounts receivable file. If the account balances are fairly evenly distributed, the auditor may want an unbiased sample and will thus choose the random sample approach. Under this method, each record, regardless of the size of the accounts receivable balance, has an equal chance of being included in the sample. If on the other hand, the file is heavily skewed with large customer account balances, the auditor may select monetary unit sampling, which will produce a sample biased toward the larger amounts.
The following stage of the confirmation process is the preparation of the confirmation requests, including the information obtained in the AR sample file. The auditor drafts and administers the requests, which are often in the form of letters, although they are written in the name of the client organization. Here is an example of a confirmation letter. We can observe that the auditor requests the customer to contact him directly with the total amount of accounts receivable from the company that was on their books as of the date specified in the confirmation letter. This is an example of a positive confirmation. Positive confirmation requests are more likely to be employed if the company's books are suspected of having problems. Moreover, this kind of confirmation letter is more typical in complex transactions since it is more accurate and it assures that everyone is on the same page and has the same financial information. This is a request to provide a response to the auditor whether or not the customer agrees with the receivable information listed in the confirmation. Thus, positive confirmation tends to be a good representation of the financial information since it's an explicit request that has been returned by the recipient. If any dispute arises, a positive confirmation is physical evidence that the information was confirmed. They are also used when confirming unusual or large balances of when a large proportion of total accounts receivable arises from a small number of significant customers. The downside is the poor response rate. Customers who do not dispute the amount shown in the confirmation letter may not respond. The auditor cannot assume, however, that lack of response means agreement. To obtain the highest response rate possible, follow-up requests up to the third time may need to be sent to non-respondents. On the other hand, negative confirmation is a request to contact the auditor only if the customer has an issue with the accounts receivable information contained with the confirmation. This is a less robust form of evidence since there is an inclination by customers to not contact the auditor, which leads to the presumption by the auditor that customers agree with the presented accounts receivable information. The sample size for this type of test is typically large and may include the entire population. Evidence from non-returned negative confirmation selected from a large population provides indirect evidence to support the auditor's expectation that accounts receivable are not materially misstated. A number of responses to negative confirmations may indicate a potential problem. Although this scenario is not conclusive due to the fact that the negative confirmations approach does not prove that the intended recipients actually received and reviewed the confirmation letters. Evidence of individual misstatements provided by returned responses cannot be projected to the entire population. Such evidence can be used, however, to reinforce the auditor's prior expectation that the account balance may be materially misstated and that additional testing of details is needed to determine the nature and amount of the misstatement. Once the auditor has decided on the nature and content of the confirmation letter, he or she can now proceed its creation through the use of a word processor. ACL's export feature and word processing package such as Microsoft Word or WordPerfect can aid on the integration of the text version of the financial data of the customers into the individual letters. In order to secure the reliability of the process and the integrity of its results, client intervention must be out of the picture. And in order to do so, the auditor should take all the reasonable steps for the evaluation and control of the responses, which includes the following. First, the auditor should retain custody of the confirmation letters until they are mailed. Second, the confirmation letters, together with the self-addressed stamped envelopes, should be addressed to the auditor rather than the client organization. And third, the confirmation request should be mailed by the auditor. If client mailroom personnel participate in the process, they should be adequately supervised. Notable feedbacks from the customer's responses should be examined and investigated further to determine whether they are indications of potential problems. Similarly, non-responses to positive confirmations were also required to be investigated. SAS 67 requires auditors to use alternative procedures to resolve this issue. A commonly used procedure is to review the following period's closed invoices to determine if the accounts were actually paid.
The next topic that I will discuss is testing valuation and allocation assertion. The auditor's objective regarding proper valuation and allocation is to corroborate or refute that accounts receivables are stated at net realizable value, meaning accounts receivable less allowance for doubtful accounts. This objective rests on the reasonableness of the allowance for doubtful accounts, which derive from aged accounts receivable balances. To achieve this objective, the auditor needs to review the accounts receivable aging process to determine that allowance for doubtful accounts is adequate. Aging accounts receivable. As accounts age, the probability that will be collected is decreased. Hence, as a general rule, the larger the number of older accounts in an organization's AR file, the larger the allowance for doubtful accounts needs to reflect the risk. Historical trends in collection success play an important part in estimating the bad debts losses for the period. A key issue to resolve by the auditor is whether the allowance calculated by the clients is consistent with the composition of organization AR portfolio and with prior years. In addition, the auditor needs to determine whether the allowance is consistent with the current economic status. For example, an organization entering into a period of economic decline may experience an increased percentage of bad debts relative to prior, more prosperous years. Now let's take a look at table 9.3. It shows the accounts receivable aging future using sales invoice. The key data fields used are invoice amount and due date. The system compares due date in the record with specific cut-off date to produce aged summaries of the invoice amount data. The default interval used are 30, 60, 90, and 120 past due. This, however, can be changed in any values that better suits the auditor needs. Oil sales invoice files contains oil sales invoices for the period. Only the open sales invoice, those blank in the remittance number field as of cutoff date should be considered in the calculation. By filtering on the remittance number field, ACL will ignore all closed invoices. Upon executing the age command, a report similar to table 9.7 will produce. This table 9.7 show the aging of accounts receivable produced with ACL. This aging report provides a clear picture of accounts receivable composition. The auditor's objective is not to assess the collectability of each account, but to determine whether the method used by the credit manager to estimate the allowance for doubtful accounts is adequate and that the overall allowance is reasonable. The auditor need to review past due balances with the credit manager to obtain information for basing an opinion on their collectability.